The Trump administration has expanded tariffs on steel and aluminum imports. A new 50% rate now applies to more than 400 goods containing these metals. For American consumers, that means higher prices on canned food, cars, electronics, and appliances. For businesses, it creates uncertainty, with no warning on which products might be targeted next. The price impact is already clear. By late July, domestic steel was nearly 9% higher than a year earlier. Aluminum rose more than 13%. These costs are passed directly into cars, refrigerators, and packaged food, squeezing manufacturers and households alike. Some manufacturers warn that certain types of aluminum aren't even produced in the US, so tariffs add costs without creating alternatives. Smaller firms are hit hardest, scaling back operations and cutting jobs in towns that depend on manufacturing. Canada has responded differently. Ottawa quickly imposed 25% counter tariffs on $30 billion worth of US goods. It also introduced quotas to control foreign steel, changed procurement rules to favor Canadian firms, and prepared financial support for aluminum producers. The strategy is clear: protect jobs, stabilize supply chains, and strengthen domestic industry. The contrast with the US is sharp. In America, tariffs promised to bring jobs back. Instead, they've fueled inflation and layoffs. In Canada, the measures are reinforcing domestic resilience. The auto industry highlights the cost. Michigan, the heart of US carmaking, is under pressure. General Motors reported a $1 billion drop in second quarter profits. Stellantis lost $2.7 billion in the first half of 2025. Ford is expected to show similar declines. Analysts warn tariffs could add $18 billion in industry costs this year alone, raising car prices and threatening jobs. Electric vehicle makers face even greater strain since the US still relies heavily on imported batteries and components. With tariffs now hitting steel, aluminum, and auto parts, supply chains are being disrupted from top to bottom. Canada and Mexico are pushing back. Canadian leaders warn Trump may even withdraw from CUSMA ahead of 2026, potentially with no formal process. Mexico has joined Canada in aligning supply chain strategies, holding high-level talks to prepare for an unpredictable US trade environment. At the same time, Canadian provinces are setting aside differences to invest in infrastructure and energy projects aimed at reducing dependence on the US market. The message is clear: if tariffs can be used as weapons, Canada and Mexico must build their own resilience. Energy is another flashpoint. Canada supplies up to 70% of US oil imports, around 4 million barrels per day. American refineries are designed for Canadian crude, making it essential to US energy security. Yet Trump has threatened tariffs on Canadian oil as well. The uncertainty is already slowing investment. Canadian oil and gas investment in 2025 is down 25% compared to recent years. Pipeline projects are stalled, leaving exports vulnerable to disruption. Prime Minister Mark Carney has refused to fold, insisting Canada won't accept a bad deal. Instead, Ottawa is diversifying exports to Europe and Asia while holding firm on energy security. Trump's tariff strategy was meant to strengthen America, but rising prices, lost jobs, and risks to its own energy supply suggest the opposite. In trying to protect US industries, his policies may be making them more fragile.